Credit rating executives got paid Wall Street-sized salaries. At the same time, the credit rating agencies were operating with an inherent conflict of interest because the revenues they pocketed came from the companies whose securities they rated. It's like one of the parties in court paying the judge's salary, or one of the teams in a competition paying the salary of the referee. The credit rating agencies assured Congress and the investing public that they could manage that conflict, that their ratings were independent and rigorous, but the documents tell a different story. First, some background. Credit ratings assess the creditworthiness of a particular financial instrument like a corporate bond, mortgage-backed security, or CDO. Essentially, they predict the likelihood that the debt will be repaid. We've all heard of AAA ratings, which are at the top of the credit rating scale and are supposed to designate the safest investments. The ratings below that, which range from AA down to C, designate investments at greater risk of default. Investments with AAA ratings have historically had an expected loss rate of less than 0.05%, while the expected loss rate for BBB investments is under 1%. That's why financial instruments with AAA through BBB ratings are generally called investment grade, while those with ratings of BBB minus or Baa3 or below are referred to as below investment grade, or sometimes junk investments. A variety of U.S. laws and regulations rely on credit ratings to gauge risk. For example, the amount of risk-based capital that a bank must hold is determined in part by the credit ratings of its investments. Some investors, like pension funds, are barred from holding below investment-grade assets. Because so many statutes and regulations reference ratings, issuers of securities and other financial instruments work hard to obtain favorable credit ratings to ensure more investors can buy their products. Over the last 10 years, Wall Street has engineered ever more complex financial instruments for sale to investors. Because these so-called structured finance products are so hard to understand, investors often place heavy reliance on credit ratings to determine whether they can or should buy them. Residential mortgage-backed securities, or RMBSs, are one of the oldest type of structured finance. To create these securities, issuers bundle up large numbers of home mortgages into a pool, figure out the total revenue coming into the pool from all the mortgages, and then design a waterfall that assigns portions of the total incoming revenue to what are called tranches. Tranches are not collections of mortgages. They are simply recipients of income from the waterfall of mortgage payments coming into the pool. Each tranche is used to issue a mortgage-backed security that receives a credit rating and is then sold to investors. The tranches that are first in line to receive revenues represent the safest investments in the pool and are designed to get AAA ratings. Tranches lower down the line get their revenues only after the more senior tranches are paid and their securities get lower credit ratings. Wall Street didn't stop there. They collected securities from RMBS transactions, put those into a pool, and re-securitized them into what are called collateralized debt obligations, or CDOs. A CDO might contain, for example, BBB-rated securities from 100 different residential mortgage pools. CDOs often also contain other types of assets, such as corporate bonds or credit default swaps. Wall Street firms are also created so-called synthetic CDOs, which did not contain actual assets but simply referenced them. Like RMBS mortgage pools, CDOs were sliced and diced into tranches, and the resulting tranches used to create securities. The securities were rated, some AAA, and then sold to investors. In exchange for large fees, Wall Street firms helped design the RMBS and CDO securities, worked with the credit rating agencies to obtain favorable ratings, and then sold the securities. Without credit ratings, Wall Street would have had a much harder time selling those products because each investor would have had to rely on themselves to figure them out.